Welcome to a new era in finance where artificial intelligence is transforming the way we bank, invest, and manage our money with unmatched efficiency, innovation, and adaptability. Hi everybody, welcome back to the BizTech Academy. I'm Steve. Today we're diving into the fascinating world of AI in finance, the future of banking and investments. This topic is close to my heart because it's not just about technology, it's about how the technology is changing our lives, our jobs, and our future. In this video, we'll explore how AI is reshaping customer experiences in banking, revolutionizing investment strategies, and providing unparalleled speed and precision. First, we'll look at the development of AI in finance. Next, we'll delve into how AI is revolutionizing the banking industry. Then we'll examine AI's impact on investments and financial analysis. We'll also look into the future possibilities of AI in finance. And finally, we'll discuss the challenges and ethical considerations as the industry embraces AI. I've added a list of these chapters to the video description, making it easy to jump to any section that interests you. And of course, if you do like this video, please give us a thumbs up and subscribe to the channel. Just press the little watermark at the bottom right hand corner of the screen. Any support you can give us is greatly appreciated. Okay, there's a lot to cover, so let's start with the development of AI in finance and how it has evolved to become a game changer. Artificial intelligence, or AI, refers to the simulation of human intelligence in machines which are programmed to, in many ways, think and learn by themselves. It's fascinating to think about, right? Machines that can learn and adapt on their own. But how does this apply to finance? Well, from the early days of data processing with manual ledgers and basic computers and chaotic trading floors of stock exchanges, we've come a long way. Today, AI encompasses a wide range of applications, including sophisticated algorithms that predict market trends and automated systems that provide personalized banking services. But the question that jumps out at me is, why did this change happen? What happened in the finance industry to require such a technological shift? Well, the financial industry has always been data intensive, handling massive volumes of transactions and complex calculations daily. Traditional methods were often slow, prone to errors, and unable to handle the growing demands of modern finance. And to this end, AI was introduced, or more accurately, evolved to address these challenges, and specifically 4 distinct problem areas. First, there was efficiency. With the number of financial transactions increasing exponentially, financial institutions needed faster and more accurate ways to process vast amounts of data. Secondly, there was fraud detection. Again, with ever-increasing number of digital transactions, the opportunity for fraud also increased, meaning improved identification and prevention of fraudulent activities became crucial. Then we have risk management. Increasing transactions and a growing array of financial products resulted in more variation and therefore more risk. AI models evolved to analyze market conditions and historical data to forecast potential risk and support better decision making. And finally, there's customer service. General technological improvements across all industries resulted in a more impatient customer. If financial institutions didn't adapt to this, they would lose customers and ultimately market share. These challenges became increasingly evident as we transitioned from the late 1980s into the early 1990s, and by the turn of the millennium in the early 2000s, AI in the financial industry began gaining significant traction. It started taking on more complex roles such as algorithmic trading, where computer programs execute trades at speeds and frequencies beyond human capabilities. Fast forward to today, and AI is deeply integrated into nearly every aspect of finance, revolutionizing how we bank, invest, and manage money. Moreover, AI is improving efficiency, creating new opportunities for innovation, and ultimately providing a better customer service. Which is a great segue into Chapter 2, where I'm going to consider specifically how AI is revolutionizing the banking sector. In today's digital age, banking has become more convenient but also more complex. With the rise of online and mobile banking, the industry faces new challenges in fraud detection, customer service, and personalized banking. And it's these 3 areas that I'm going to look at now, starting with fraud detection. Traditional methods of detecting fraud were often slow and reactive, identifying issues only after significant damage has been done. AI has changed this. AI algorithms excel at analyzing patterns and detecting anomalies much faster than humans. For instance, JP Morgan released its contract intelligence software in 2017, which, by making use of machine learning, automates the document review process. This automated process takes a matter of seconds to review lengthy legal documents that otherwise would usually take days to weeks of lawyers' times at immense cost. By extending this technology, AI can be used to monitor transactions in real time and flag suspicious activities and unusual patterns for further investigation, helping banks prevent fraud before it causes significant damage. If I now turn to customer service, there is no doubt that with the rise of digital banking, customers expect instant support and a personalised service. However, traditional customer service methods like call centres are often not only costly but overwhelmed and slow to respond. AI-powered chatbots and virtual assistants, on the other hand, offer 24/7 customer support, answering queries, assisting with transactions, and even providing financial advice. For example, Bank of America's Erica helps customers manage their finances. Erica can handle anything from checking your balance and paying bills to providing personalised financial tips. Similarly, HSBC's AI-powered chatbot Amy handles customer inquiries and helps with tasks like resetting passwords or locating nearby ATMs. And moving to personal banking, and as customers demand more personalised financial advice, banks need to offer tailored solutions quickly and accurately. By analysing customers' financial data, spending habits and goals, AI within banking can provide tailored recommendations for saving, investing and spending. Wells Fargo's predictive banking tool, for example, analyses a customer's account's activity to provide insights and recommendations, notifying customers of potential overdrafts or suggesting ways to save based on their spending patterns. Additionally, robo-advisors like Betterment and Wealthfront use AI to offer personalised investment advice and portfolio management, making high-quality financial planning accessible to everyone. And all this is great for the consumer, but there is a downside. As banks gain more insights into our spending and saving habits, they often intensify their efforts to promote their products and services. And while this is a natural business strategy, it can become frustrating for consumers. Banks need to carefully balance providing support with not pushing too aggressively, which could potentially drive customers away. AI in banking is about more than just automation to generate more profit. It's about enhancing security, improving customer experiences, and providing personalized services that meet individual needs. Which takes us nicely to Chapter 3, where we'll explore in more detail AI's impact on investments and financial analysis. In today's fast-paced financial markets, the ability to analyze data quickly and accurately is more important than ever, and AI is at the forefront of this transformation, revolutionizing how we invest and conduct financial analysis. In this chapter, we'll explore how AI is used in risk management, data analysis, predictive analysis, sentiment analysis, and to start with, algorithmic trading. AI is used to predict market trends and execute trades at speeds and frequencies that humans simply cannot match. These systems can identify patterns and trends, making split-second decisions to buy and sell financial assets such as stocks and shares. One prominent example is Goldman Sachs. Their AI-driven algorithms analyze vast amounts of market data to execute trades. These algorithms can process information at lightning speed far beyond human capabilities and continuously learn from market data, automatically refining their strategies to improve performance over time. This gives Goldman Sachs a competitive edge in this highly volatile world of trading. AI also plays a critical role in risk management, helping identify and mitigate investment risks. By analysing market conditions and historical data, AI can predict potential risks and recommend strategies to mitigate them. Hedge funds like Bridgewater Associates use AI to optimise their investment strategies by predicting market movements and identifying potential threats, ensuring more stable and profitable investments. AI-driven data analysis allows financial institutions to process massive amounts of data quickly and accurately. This helps in uncovering valuable insights and improving decision-making. Predictive analytics is another powerful application of AI in financial analysis. It helps forecast market trends and financial performance by analysing historical data and current market conditions. Hedge funds like Two Sigma use predictive analytics to anticipate market movements and adjust their strategies accordingly. Another example is Morgan Stanley's AI-based predictive analytics platform, which helps financial advisors provide better recommendations to their clients. And last but by no means least, we have sentiment analysis. AI can gauge market sentiment by analysing social media, news, and other sources of public opinion. This provides valuable insights into how news events or social media trends might impact market behaviour. Investment banks like UBS use AI-driven sentiment analysis to understand investor sentiment and adjust their strategies based on public opinion. Bloomberg does the same with its AI-powered sentiment analysis tool, which scans news articles and social media to provide real-time insights into market sentiment. AI in investments and financial analysis is not just about crunching numbers. It's about enhancing our understanding of the market, reducing risk, and improving decision-making. And AI is already well integrated in the finance industry. So what's next? Well, in the next chapter, we'll explore the future trends and innovations in AI and finance, and this is where it gets exciting. Emerging AI technologies are poised to take the financial sector to new heights. One such technology is blockchain, but by this, I don't mean Bitcoin or cryptocurrencies generally. I mean blockchain technology itself, which offers a decentralized and secure way to conduct transactions. By combining AI and blockchain, financial institutions can enhance the transparency and security of transactions, reduce fraud, and improve efficiency. Blockchain's potential goes beyond just secure transactions. It can revolutionize everything from cross-border payments to smart contracts, providing a robust framework for financial innovation. Santander, for example, has launched a blockchain-based international payment system called OnePay, utilizing the Ripple blockchain that reduces transaction times from days to minutes. And although the service has limited coverage to date, Santander claim they have reduced international payments to just 3 clicks and 40 seconds. Quantum computing is another game changer. Quantum computers can process complex calculations at unprecedented speeds, making them ideal for tasks like risk analysis, portfolio optimization, and fraud detection. Additionally, quantum computers can significantly enhance the encryption of financial transactions, making them virtually unbreakable. Then we have biometric authentication, where AI-powered systems that use fingerprint, facial recognition, and even voice recognition are making financial transactions more secure and more convenient. These technologies are being integrated into banking apps and ATMs, providing a seamless and secure user experience. Citibank, for example, uses facial recognition for ATM access, enhancing both security and customer convenience. AI is also driving innovation into financial planning and advisory services. Companies like Vanguard are developing AI tools that offer personalized financial advice, helping clients plan for retirement, manage debt, and achieve their financial goals more effectively. But what about the longer term? How will AI impact the finance industry over the next 5 to 10 years? Well, firstly, we can expect AI to become even more integral to the decision-making process. Advanced AI systems will provide real-time insights and recommendations, helping financial professionals make better informed decisions. AI's role in personal finance will also expand significantly. We will see the rise of hyper-personalization, where financial products and advice are tailored to the unique needs and preferences of each individual. This could significantly improve customer satisfaction and loyalty, as well as financial performance. And AI's capabilities in regulatory compliance will also grow, with AI-powered systems helping financial institutions stay compliant with evolving regulations by automating monitoring and reporting processes. We may also see the advent of autonomous financial advisors. These AI-driven entities could provide financial advice, manage investments, and even execute transactions independently, offering a new level of convenience and efficiency. Imagine having an AI advisor that monitors the markets 24/7 and makes real-time adjustments to your portfolio while you're asleep. And looking further into the future, there are several potential innovations that haven't been implemented yet but hold great promise, including the integration of AI with virtual and augmented reality. Imagine virtual financial advisors that can meet with a client in a virtual space at any time, providing interactive and immersive financial planning experiences. And you know what? This may not be that far away. The speech technology already exists. ChatGPT's 4.0 release allows for two-way conversation with an AI-generated assistant. Tailor this with the bank-specific service offerings and link this with a holographic human, and the virtual financial advisor comes alive. And expand this thought further, and it's clear that AI could also play a role in enhancing financial inclusion. By providing low-cost, AI-driven financial services to underserved populations, we can help bridge the gap and provide access to banking, credit, and investment opportunities for everyone. In fact, organizations like Tala are already using AI to offer microloans to underserved populations, particularly in developing countries. This helps individuals build credit histories and gain financial stability. Listen to Tala's CEO, Shavana Soroya, explain how this service works.
We're a data science and mobile technology company that is opening up financial access to 3 billion people around the world. The way that we're doing that is through our Android application that allows us to instantly credit score someone using just the data on their smartphones. So this is data about their daily lives. And so based on that credit score that we develop through the application, we then also act as the lender.
What data are you getting from your customers, and which data are you not looking at?
The data that we're bringing in is directly from our customers. And so we're very transparent about the kind of information that we are asking them to provide us access to, which is sitting on their smartphones. And so the kind of data we're really focused on is identity data, So we want to understand, is the person that's holding this device and applying actually the person that they say they are? That's the first thing. The second thing is we're looking at capacity data. So we want to understand, what's the consistency in your bill payments? Do you pay your electricity bill on time, your phone bill on time? We want to understand, are you an employed individual? Are you a sole proprietor running a business? So then we want to understand, what's the inflows and outflows of your income? And so this is the kind of data in emerging markets that's actually sitting on people's devices.
This is just an excerpt of a longer interview, and I've added a link to this in the description. It's very interesting what Shivani has to say, and it's clear that as we move forward, the financial industry will continue to evolve, driven by advancements in AI and other technologies. However, and there is always a however, as with all innovation, the reality of mass adoption is not always what it seems. In our final chapter, we'll explore the challenges and ethical considerations surrounding the use of AI in finance. Financial institutions handle vast amounts of sensitive data, and protecting this data is paramount. AI systems, while powerful, are also vulnerable to cyber attacks and data breaches. To address this, financial institutions are investing heavily in cybersecurity measures. They use advanced encryption techniques, multi-factor authentication, and continuous monitoring to protect data, and in many cases have dedicated cybersecurity teams that work around the clock to safeguard customer information. Another major challenge is the risk of algorithmic bias. AI systems are only as good as the data they're trained on, and if this data contains biases, then AI can perpetuate and even amplify these biases. This can lead to the unfair treatment of certain groups and unethical decision-making. To combat this, companies are implementing measures to identify and mitigate biases in AI algorithms. For instance, Microsoft and Google are developing fairness toolkits that help detect and correct biases in machine learning models. Financial institutions are also conducting regular audits of their AI systems to ensure fairness and transparency. And transparency and explainability are significant challenges themselves. Many AI systems operate as black boxes, meaning their decision-making processes are not transparent. This lack of transparency can make it difficult to understand how decisions are made, which is problematic for both regulators and customers. Financial institutions are addressing this by developing interpretable AI models that provide clear explanations for their decisions. For example, the Explainable AI initiative aims to create models that can articulate their reasoning in a way that humans can understand. Additionally, regulatory bodies like the European Union's GDPR are enforcing transparency requirements, compelling companies to explain AI-driven decisions to their customers. These are just some of the challenges the finance industry is facing with its adoption of AI, but there are also ethical questions that need to be addressed, with probably the primary one being AI's potential for job displacement. As AI systems become more capable, there is a risk that they could replace human workers, leading to job losses. Financial institutions are addressing this by investing in reskilling and upskilling programs for their employees. For example, Citigroup has implemented a workforce transformation initiative that trains employees in new technologies and prepares them for evolving job roles. Then there is also the need for accountability. Who is responsible when an AI system makes a mistake? Establishing clear accountability frameworks is essential to ensure that there is always a human in the loop who can take responsibility for AI-driven decisions. To tackle this, financial institutions are setting up AI governance committees that oversee the deployment and use of AI technologies. For instance, JP Morgan has an AI ethics board that reviews and approves AI projects to ensure they adhere to ethical standards. AI has the potential to democratize access to financial services, but only if it is implemented in a way that prioritizes inclusivity and fairness. However, overcoming these challenges and addressing ethical issues requires a multifaceted approach involving collaboration between financial institutions, regulators, and technology providers. And the good news is that financial institutions are working closely with regulators to ensure that AI technologies comply with legal and ethical standards. Collaborative efforts such as the Financial Stability Board's AI principles aim to create a unified framework for the responsible use of AI in finance. These principles focus on governance, accountability, transparency, and fairness. Industry-wide initiatives like the Partnership on AI bring together stakeholders from different sectors to share best practices and develop guidelines for ethical AI use. By fostering open dialogue and cooperation, these initiatives help build trust and ensure that AI technologies benefit everyone. As we move forward, it's essential that all stakeholders work together to create an ethical and inclusive financial ecosystem. This involves continuous evaluation, open communication, and a commitment to responsible innovation. Okay, we're just about there for today. As we have seen, AI is revolutionizing the financial industry by enhancing efficiency, security, and personalization in banking, investments, and financial analysis. However, the journey of AI in finance is only just beginning, and as we look to the future, the promise of new innovations and advancements is both transformative and exciting. Thank you for joining me in this deep dive into the world of AI in finance. I do hope you found it useful and insightful. Stay tuned for more videos exploring the fascinating intersection of technology and finance. But until next time, I'm Steve, and this is the BizTech Academy.